This is Nightly Business Report with Bill Griffith and Sue Herrera.
All-time highs. The Nasdaq closes at levels never seen before as key tech stocks power higher. But what happens when those leaders start to falter? Full steam ahead. The Fed chief says the economy is on solid footing and investors should expect more rate hikes, at least for now. Laying the groundwork. As lumber prices rise, producers are scrambling to hire workers and expand their business. Those stories and much more tonight on Nightly Business Report for this Tuesday, July the 17th. And we bid you good evening, everybody. Sue is off again tonight. The hottest part of the market got a little hotter again today. Technology stocks led the Nasdaq to yet another record close. It's 24th of this year. Among the tech giants, Amazon hit another new all-time high. Alphabet and Microsoft also rose, but shares of Netflix went the other direction today, down more than 5% after reporting disappointing subscriber growth numbers, which we told you about yesterday. When all was said and done, the Dow rose by about 55 points to 25,119. The Nasdaq was up 49 to that record. The S&P added 11. Now, despite the Nasdaq's all-time high and the continued rise of the other major averages, there are some troubling issues that threaten this bull market's future. Mike Santoli takes a look now at the storm clouds hanging over the market.
The stock market's condition is always in the eye of the beholder. While many investors have been heartened by the broad index's recent climb to within a few percent of their record highs, the growling of market bears has only grown louder in the last 6 months since the market has gone mostly sideways. So what exactly are the bears saying to argue the market is looking shaky? And do they have a good case? Well, the bears' argument on stocks often starts with bonds. The stubborn refusal of long-term Treasury yields to climb convincingly above 3%, even as the Federal Reserve pushes up short-term rates, is cited as a classic leading indicator of a recession. The fact that this economic expansion is nearly the longest in history and trade war fears are flaring adds a bit of urgency to this observation. Then there's the charge that the stock market's 2018 gain of a bit more than 4% has been driven almost exclusively by a handful of huge tech stocks such as Amazon and Netflix. Bears also see peak activity everywhere. U.S. economic momentum and corporate profit growth is peaking as the initial tax cut boost fades, they say. Even heady readings on corporate and small business confidence are said to represent peak optimism. So do the bears have a point? While it's true the narrowing of yields between short and long-term bonds is a common pattern toward the latter part of an economic cycle, the current setup is one typically seen well over a year ahead of a recession, and some argue that long-term yields are being pulled artificially lower by rock-bottom rates in Europe and Japan, which weakens their economic signal. As for the supposed narrowness of the stock rally, it's true the dominant tech leaders have accounted for more than their share of this year's gains, but it's not as if the rest of the market is outright weak. Small cap stock indexes are up 10%, and more than half of all stocks in the S&P 500 are positive on the year. As for peak growth concerns, there's little doubt that momentum will slip in the latter part of the year and into 2019, but this is not unusual as a bull market matures, and typically stock indexes can avoid deep or lasting losses so long as the economy avoids an outright recession and companies can post even modest profit growth. Bottom line, most of what the bears are talking about are simply the typical conditions that surface as an economic cycle and bull market get into a later phase. But many of these indicators have very long and uncertain lead times when foretelling tougher times, and none has a perfect record even then. So even if it's no longer early in the game, it doesn't mean the bull market is about to end. For Nightly Business Report, I'm Mike Santoli.
Now, Mike just mentioned the tech stocks that have been pulling this market higher. Netflix, of course, has been a cornerstone of that group, one of the best performing stocks this year. But it was one of the worst performers today following those disappointing subscriber numbers. The pullback in that stock got us thinking about its importance to the broader market and what might be next for that streaming video juggernaut. Julia Borston picks up that part of the story for us now.
Netflix CEO Reed Hastings attributing the streaming giant's disappointing subscriber growth and outlook for the third quarter not to any internal issues or to competition, but to the challenges of forecasting and typical dips in the second quarter. Analysts are now looking at what Netflix needs to do to justify its valuation.
The key is, can they get their mojo back in gear in the quarter that we're in right now, the third quarter, and create content that people care about a lot more than they did last year. You know, last year in the second quarter, they had this show 13 Reasons Why, which was hugely impactful, tons of buzz. Nothing in this quarter came close to matching that.
But analysts are still optimistic about the potential for expansion, especially internationally. The second quarter was the first time that international streaming revenue surpassed the revenue from domestic subscribers. And the company says that trend will only continue.
The growth is going to come internationally. I think with Netflix numbers from yesterday, their international growth was a little off, not off that much, so it's not that bad.
The big question for Netflix's future, the impact of growing competition. Looking forward, Hastings says he expects the combined AT&T and Warner Media and Fox and its eventual buyer, either Disney or Comcast, to be more formidable rivals, also pointing to Disney launching its branded streaming service next year. The other issue, Netflix will lose some Disney movies currently on the site when Disney launches its own service.
I think they feel like they've got to have it all, and especially with the Disney relationship rolling off next year, which has been a huge source of movie content for them, that's going to create a hole that they've got to fill, which is why you're seeing them focus on that maybe a little bit more than they have in the past.
Hastings says Netflix is still growing viewing hours among their 130 million subscribers and investing some $8 billion in content this year to keep those subscribers hooked. For Nightly Business Report, I'm Julia Borston in Los Angeles.
So what does Netflix bump in the road mean for the other high-flying tech stocks and the broader market? Mike Bailey is Director of Research at FBB Capital Partners. He joins us tonight to talk about this. Mike, thanks for joining us.
Thanks for having me.
The so-called FANG stocks, Facebook, Amazon, Netflix, Google, or what we call Alphabet now, and maybe a couple of others, Apple and Microsoft, they've seen the lion's share of the gains for the market in the last several months. Is that a good thing or a bad thing?
Well, I suppose it depends on your perspective. If you've owned some of them or all of them, that certainly has helped. If you take a broader perspective, I think you're always going to have a bell curve. You're going to have some winners and losers. These 5 or 6 companies have been winners for a number of years now. I think we can talk about possible sort of rising risks, if you will. You're seeing more sort of market value get concentrated in a few names. That's the fear side. The flip side is look at the fundamentals. I mean, the earnings are just growing like crazy. They're really sort of backing up this investor excitement with real dollars and cents. So as long as that continues, we do think that these names will continue to grow nicely.
But clearly, it's not lost on anybody that these stocks are seeing good fundamentals. I mean, a lot of people feel many of them are very expensive right now. So when you start to see maybe a little peak in growth, like we're maybe hinting at Netflix here with this disappointing subscriber growth number, the question becomes, do they go sharply lower? And when that happens, what happens to the rest of the market?
Great point. So to kind of connect those dots, we try to kind of keep it simple, and we essentially think that stocks chase earnings. So we really keep an eye on earnings for these companies. So we take a look at Netflix, for example. They've got a history of sort of 1 or 2 quarters off and then 5 or 6 on. So the question is, they had one tough quarter. Maybe they have another one or so. But I think that they've still got a pretty good runway to go. So I think the fundamentals probably continue for them. The question is, sort of broaden that out to the rest of the market and the other FANG stocks. The drivers are actually fairly different, I'd argue. So I think probably maybe a slightly more bullish view would be thinking that, okay, you've got 5 or 6 FANG stocks. Maybe there's some more risk in the market, but fortunately, those risks are really divided out across different areas. So you've got media with Netflix, you've got advertising with a Google or Facebook, you've got smartphones on one hand, you've got e-commerce with an Amazon and sort of cloud computing. So you have a lot of different things happening. I do think that does help to kind of diversify that risk out from concentrating into 5 or 6 names.
Are you among those who feel that eventually, when the FANG stocks kind of, have peaked to some degree, that you get leadership from other groups, the financials, the energy, the industrials, some of the other usual suspects, if you will?
Absolutely. So I think the key question here is, what's the rest of the economy doing? So if the economy is running a little hot right now, we think that might slow down a bit over the next year or so. If the economy is still running, let's say 2-ish%, you can see some nice growth, energy, financials, industrials, some other areas. However, you're probably just not going to see another group of mega cap companies doing what the FANGs are doing. I can't think of any other sort of traditional, either blue chip or sort of high growth industrial or financial company that's got really the kind of upside that the FANGs do. But you could have a company, for example, let's say healthcare, sort of boring, staples, defensive healthcare. United Health, it's the second largest healthcare company in the world.
Right.
They're growing pretty nicely. So you could certainly have some growth, call it 20, 25%. You might not have the 80 or 90% growth, which you're seeing with Netflix or Amazon, but still 20s, 30% growth is still pretty compelling.
Indeed. Mike, I enjoyed the conversation. Mike Bailey with FBB Capital. Thanks for joining us tonight.
Thanks for having me.
A lot of earnings out. Johnson & Johnson was the best performing stock in the Dow today after it reported better than expected results, fueled by the company's pharmaceutical and medical device businesses. Results from J&J's consumer unit were weak, but that's not worrying the company's CFO.
It's a business that we have strong plans for in the second half with a relaunch of not only the baby brands, but also a number of new product introductions.
Overall, investors liked the report. The stock was up 3.5% in today's trading. Shares of United Health that Mike just mentioned, they moved in the opposite direction. The nation's largest health insurer fell more than 2%, making it the worst performer in the Dow today. This despite a double-digit rise in profit and an upbeat outlook. As Bertha Coombs explains, it all comes down to costs.
United Health saw membership growth across its Medicare, Medicaid, and commercial insurance plans, as well as its Optum data, medical care, and pharmacy benefit units. But some unit revenues during the quarter were not as strong as analyst estimates, while medical costs were a little higher than expected. That doesn't worry United investor Les Funtlater.
It was negligible, but we're so used to United beating numbers that when they didn't quite beat numbers, I think people got nervous.
But CEO David Wickman assured investors on the company's earnings call he feels United should be doing better, especially when it comes to technology to make life easier for members.
By most measures, there's nothing wrong here. I don't want to leave you with that point of view, but by most measures, with a company of the capacity that this one has, I just believe we should be able to move faster with greater speed and agility to respond to emerging market demand for these kinds of services.
He pointed to the growth of United's Rally Health digital platform, which helps members find cost savings and earn rewards for maintaining wellness, all via mobile.
My view is we need to get these into the hands of consumers faster and make a bigger difference on how the effectiveness of health systems and the health of people.
As consumer tech giants like Amazon move into healthcare through acquisitions like PillPack, health plans are increasingly feeling the pressure.
And that's because healthcare is becoming more consumer-oriented, either because of Amazon or in spite of Amazon. And so to the extent that it helps all of these businesses become more consumer-friendly, I'm all for it.
Notably, one potential challenge United did not mention was the Trump administration's proposed drug price reforms. With proposals still in the comment period, analysts say new rules that might impact the pharmacy benefits business are still likely several months away. For Nightly Business Report, I'm Bertha Coombs.
And yet another Dow component, Goldman Sachs, had a blowout quarter. Profits surged by 40%, exceeding analyst estimates. Revenue was better than expected in every major business unit except trading, but the stock slipped slightly after Goldman said that the legal and regulatory costs rose during the quarter. Goldman Sachs also made official what we have been reporting, namely that David Solomon will take over as CEO on October 1st. One of his challenges will be to continue to focus on Goldman's most famous business, deal-making, while also expanding the firm's newest business, its consumer division. Time to take a look at some of today's upgrades and downgrades, with Dow component Intel leading the way. It was downgraded to inline from outperform at Evercore ISI. The analyst cited rising competition from NVIDIA and AMD. The price target is now $54, with the stock down a fraction today at $51.75. Goodyear Tire was given a rare sell rating by Goldman Sachs. The analyst cited an increase in raw material prices. Price target now $18, and shares fell more than 1% to $22 even today. Tribune was upgraded to overweight from equal weight at Stephens. The analyst there is dismissing those new FCC concerns about Tribune's proposed merger with Sinclair Broadcasting. This analyst feels the deal will still close in its current form. Price target $45. The stock rose more than 3% to $33.32. Still ahead, an industry that is breaking new ground as it builds upon new opportunity. Federal Reserve Chairman Jerome Powell told lawmakers today that strong economic growth should keep the central bank on track to gradually raise short-term interest rates. He made those comments before the Senate Banking Committee as part of his semi-annual report to Congress. And our Steve Leisman was there.
Good morning, Chairman Crapo.
Fed Chairman Jerome Powell telling Congress that the best way to keep the U.S. economy growing is to continue raising interest rates. In his semi-annual testimony before the Senate, Powell gave a solid outlook for the U.S. economy, saying the job market is strong, unemployment will fall further in the months ahead, and inflation has more or less hit the Fed's 2% target.
I think gradually raising rates is the way for us to extend this expansion. Nothing hurts working families and people at the margin of the labor markets more than a recession.
And Powell said wages were not rising fast enough yet to cause an inflation concern. That was something of a dovish comment. He added there is room for wages to grow without sparking inflation. Powell said it was too soon for the tax cuts from last year to be helping wages right now, and the ultimate effects of all the fiscal policy, the tax cuts and the additional spending, will be hard to gauge. Overall, he said, though, the tax cuts have had a positive impact on the economy. Though Powell tried to steer clear of direct comments on the trade controversy because he likes to stay away from politics, he did offer something of a generic warning.
In general, countries that have remained open to trade, that haven't erected barriers, including tariffs, have grown faster, they've had higher incomes, higher productivity, and countries that have gone in a more protectionist direction have done worse. I think that's the empirical result.
Powell said there had already been some reports of businesses canceling or delaying capital spending plans because of the tariffs. But he held out hope that better trade agreements could ultimately come from the process. He'll sit before the House tomorrow in day 2 of his testimony. For Nightly Business Report, I'm Steve Leisman in Washington.
By the way, the Fed chair also made the case for housing finance reform. Mr. Powell said he thinks it's important in the long run that the housing finance system get off the government's balance sheet. As you may remember, Fannie Mae and Freddie Mac were taken into conservatorship during the financial crisis a decade ago. Speaking of housing, home builder sentiment remains steady, even as the cost of materials rise. Lumber prices, for one, have risen sharply after the U.S. imposed those duties on Canadian lumber last year, and that has spurred domestic lumber producers to expand production. Diana Olick is in Dover, Foxcroft, Maine for us tonight.
In the woods of central Maine, Pleasant River Lumber is moving a lot of logs, cutting lumber day and night as the company's co-president, Jason Brochu, lays the groundwork for big expansion.
We're more confident in our industry and in the economy and in the housing market.
And in the value of his commodity. Framing lumber shot up 50% in the first half of this year to a record high, as a perfect storm swirled around Canadian supply. Forest fires, a transportation shortage, and new duties imposed by the U.S. on Canadian lumber.
In 2017, we were expecting the tariffs to increase home prices by about $1,300, $1,400. It's gone way beyond that, and right now the current impact is about $7,500.
A blow to the bottom line of home builders and buyers, but a boon to U.S. lumber producers.
With the duties that are in place, that's given us a level of confidence that we didn't have before, that we have a level playing field.
Brochu said he's putting $20 million into his business, planning to expand production by 50% in the next 2 years and adding about 40 more workers to the 300 he already employs.
The Canadian lumber duties are giving U.S. producers both the capital and the confidence to increase production. But there is one thing they cannot grow in these forests, that is steel.
The U.S. just slapped new tariffs on Chinese steel, aluminum, and machine parts, increasing the costs to expand mills like this one. Brochu claims he's not worried.
it's not a factor in our decision making. You know, we're not looking ahead saying, oh, gee, stuff might be more expensive, we better hold back. You know, we feel that, you know, confident that we'll be able to put in the equipment we need at the price we need to put it in and expand and grow, and, you know, and we're going to do that.
Lumber prices have been rising for a year, but so far, sawmill employment and production are both flat.
We've seen a couple of % increase in the volume of lumber production in the United States, but it's not keeping up with the demand, particularly the growth in single-family construction.
Which means American home builders won't see much relief in the short term, even as U.S. lumber producers take Made in America to a whole new level. For Nightly Business Report, I'm Diana Olick in Dover Foxcroft, Maine.
United Continental raises its full-year earnings forecast, and that is where we begin tonight's Market Focus. After the bell, the airline reported better than expected results thanks to adding more flights, and in turn, that was raising its profit outlook. But United also said that rising fuel costs would cause it to trim its capacity growth estimates for 2018. Shares were initially higher in after hours. They finished the regular day up a fraction at 72.62. Also out after the bell tonight, railroad operator CSX delivered earnings and revenue that topped expectations. CSX said that cost cuts helped it bring its operating ratio down to a level that it hoped to reach by 2020, so it's early. CSX shares initially took off in the extended session. They ended the regular day up a fraction to $64.44. Higher inflows and a rise in trading revenue helped Charles Schwab's profits rise at a faster than expected clip. Total revenue at the brokerage also picked up and topped estimates. Shares rose more than 3.5% today to $52.88. Omnicom Group said that strength in Europe wasn't enough to offset a loss of several clients in its domestic business. As a result, the ad agency reported weaker than expected sales growth and warned that revenue could still be pressured in the coming months. Shares were off more than 9% to $70.69 today. Also late today, Texas Instruments said that CEO and President Brian Crutcher has resigned after it was revealed that he violated the company's code of conduct. That's all we know about it. Technology company said the current chairman will take over as chief executive and president and will continue to serve as chairman as well. Shares were lower after hours on that news, but they did end the regular session higher by 1% to 115.80. Coming up, it's fast, it's furious, it's one of the rarest cars around. Four states sued the federal government today to void the new cap on the federal deduction for state and local taxes. The states are New York, Connecticut, Maryland, and New Jersey. They say the $10,000 cap disproportionately harms high-tax states and depresses home prices, spending, and job economic growth. The lawsuit comes 7 months after the president signed into law that $1.5 trillion tax overhaul that included the deduction cap. It is the most expensive car in the world, and the first one to come off the assembly line was delivered today to a man who bought it sight unseen. Robert Frank was there.
Well, imagine buying a car without ever driving it or seeing it. And imagine that car costs $1.3 million. Sound nuts? Well, Michael Fuchs admits that he's more than a little car crazy.
Thank you.
Congratulations.
Thank you.
Today, Michael was the first in the world to receive the new $1 million supercar from McLaren. It's called the Senna, and it sold out before it was even launched. They're only making 500, and we were there as it rolled off the truck and Michael got his first look at his new ride.
After seeing the car, wow. That's all I can say is wow.
The ceremonial car delivery has become a new battleground for the world's ultra-luxury car companies. Most of us just get a key and free rubber mats from the dealership. But supercar companies are staging elaborate events with celebrities, social media campaigns, and top executives there for the handoff. Michael is one of the top car collectors in the country with over 140 cars, and he is the ultimate American dream story. He emigrated from Cuba at 15, started selling used tires in Newark, New Jersey, and eventually launched and sold more than a half a dozen companies, earning the title as the mattress king from founding Sleep Innovations and the Comfort Revolution. Now, he said buying cars is not about status, but about creating one-of-a-kind colors and interiors that he considers works of art that will appreciate in value. The color for his new green machine came from a pair of emerald green shoes.
I love to create my own colors. I love to create my own combinations. And I get great satisfaction when I see the end result. You know, many times people say to me, "You're nuts. It's not going to look right in that color." And then they see the car and they flip out.
The supercar market remains super strong, especially in the U.S., but producers from Ferrari to Bugatti to McLaren are all concerned about the potential impact of auto tariffs.
We're kind of in a wait-and-see position right now, so we can't really comment on that until we actually understand more what's going to happen. And we're hopeful that it doesn't transition into something.
Of course, for Michael Fuchs, another $200,000 isn't likely to slow his car habit. For Nightly Business Report, I'm Robert Frank.
And finally tonight, the richest person in modern history is now Amazon CEO Jeff Bezos. His net worth topped $150 billion for the first time yesterday. That's about $55 billion more than what Microsoft co-founder Bill Gates is currently worth. According to Bloomberg, that makes Bezos richer than anyone else since at least 1982, when those figures were first collected. And today, as we mentioned, Amazon closed at yet another record, so his wealth continues to go higher. Before we go, another look at the day on Wall Street. Gains across the board with the Dow up 55. The Nasdaq had a new record, the S&P up 11. That is Nightly Business Report. I'm Bill Griffith. Enjoy the rest of your evening. We'll see you tomorrow.